Whole life insurance is one of the most powerful assets in the world when you utilize it properly. And one of the best attributes of a whole life insurance policy is the loan provision. Whether you realize it or not, if you utilize a whole life policy as a cornerstone foundational asset in your life, it can enhance every single thing you do in your life when it comes to your personal finances. However, there are a lot of misunderstandings about how these work, why they work the way they do, why life insurance companies offer the policy loan provision the way that they do. Are you paying yourself interest? Are you paying the insurance company interest? Things like Dave Ramsey says, why would you pay interest to borrow your own money? What does that even make sense? Why would you do a thing like that? In this video, I'm gonna cover all of these topics. I'm gonna hopefully make it make sense for you. And if you have any questions, comment in the comment section below. If you haven't already, make sure you subscribe and hit the bell. That way you're notified every time I launch a new video. Let's get into it. Hey, what's up, Cashflow hackers? It's Chris with Life 180. This video, we're gonna be talking about whole life insurance policy loans, how they work, why you would wanna take a policy loan out, why the life insurance company loves you taking policy loans out, some areas where life insurance companies actually don't like you to take policy loans out, where the risk is for you, where it works really well. I'm gonna try to cover all of this and talk. Usually I would bring up an illustration, but I wanna just, like you can see I've got on the board back here, I wanna just kind of talk philosophically about some stuff. I've got like a hypothetical case study that I kind of wanna walk through. I haven't practiced this, I haven't worked it out. I'm just gonna kind of go off the cuff based on what my line of thinking is as I go through it. I'm sure it'll kind of be different than what I'm thinking it's gonna be right now. But one of the things that I really wanna communicate in this video is how policy loans work. A lot of people in the infinite banking space will tell you that the reason that you want a whole life insurance policy is because you wanna take control of the banking function in your life. That is the whole purpose of a banking style policy. Now, infinite banking is simply a marketing term that people utilize, and it's phenomenal. And there's more of a philosophy that goes along with it. But from a actual policy standpoint, how do the policy loans work? How does it impact you, your personal life, your business, whether you're using it for an emergency fund, an opportunity fund, an investment account to fund real estate investments, whether you're using it as like a day trading account, whether you're using it as a capital reserve fund for your business, anything of that nature. I believe it works amazingly in all those areas, but how you utilize it, how you leverage it, and understanding the moving parts inside of it is gonna really be the determining factor as to whether it works for you or not, whether it becomes the greatest asset in your life that helps make everything better, or whether it's something that you mismanage and it becomes a problem. So here we go. Let's get into it. I'm going to hop to the board, and I think I'm going to hop to the board. There we go. I'm going to hop to the board, and we're going to get into this. So now what you can see here is that I've got this sample case going up. So let me just kind of break this down for you. You can see here I've got year 1 through 10, and you can see this is cumulative. So this is year 1, year 5, year 10. Cumulative premium, year 1, we're talking about a $10,000 a year. So year 5, you've got $50,000 in premium. Year 10, you've got $100,000. And then net cash value, I'm just ballparking this stuff, right? Just to talk concepts, principles, whatever, right? Just to get the idea and the feel. Now you can see year 1, we got 7,000 liquid net cash value. Now remember, you can access, we'll just call it 90% of whatever is in this column is what you're able to access. The death benefit is 500,000, but because we're utilizing the dividends to buy more paid up additions, the death benefit is gonna climb as the cash value climbs. And this is one of the areas where Dave Ramsey says, well, why would you put your money into an account where you have the death benefit, you only get paid the death benefit, not the cash value and the death benefit. The life insurance company keeps the cash value. But you can see here, once again, this is just an example, but this principle remains true if you utilize the right design in a policy. You could see here, you started off with 500,000 of a death benefit. It grew to 640, and this is pretty accurate, right? It grew to 640 in 10 years. But your cash value grew by 115, so the death benefit actually grew by more. And so really the life insurance company is keeping this cash because they're able to then grow your death benefit as the cash grows. And they do that because if they were to separate the two, you'd have to get taxed on the 115, whereas they give it to you as a tax-free death benefit over here. So, excuse me, what Dave Ramsey says as a big negative to this is actually a really big positive. Now, sorry, that nothing to do with this overall topic of the video, but I think it's a an area where people have a lot of questions, and I think it's something that needs to be understood on a deeper level. Now, let's get into the loans, right? Now, let's say you get to year 5 right here, and you got $49,000, and you want to take a $40,000 loan, and you want to take a loan from the whole life policy. And let's say your whole life insurance company charges you 5%. Now, a year ago, it would be about 5%. Let's just say it was a year ago, and they were going to charge you 5%. Well, and let's say you wanted to do this to buy a car. You wanted to buy a $40,000 car, and the whole life policy loan would be 5%. Well, let's talk about that for a sec. Most purists for infinite banking will say you want to go and you want to utilize the whole life policy loan no matter what, because you're regaining control of the banking function in your life. The whole purpose of the policy is to eliminate the need for banks. Well, there's always a cost to money. So the idea here, there's 2 things I want to cover here, is A, they're saying that if you could earn, let's say the dividend in this company, let's just say here, I'm gonna put the dividend. Let's say the dividend is 5.5%, okay? So they're gonna say, because if you use a non-direct recognition company, NDR, I'm just gonna call it, if you use a non-direct recognition company, they're gonna say, take a $40,000 loan, we'll just say they're gonna take 40K, and you pay 5% on it, and all the while you're gonna earn 5.5%. Well, that's not true. Because this 5.5% with a dividend rate is not a net rate, that's a gross rate. And so then you have to back everything out of that, all the expenses, all the cost of insurance and all that stuff. And so it's not necessarily, there's not baked in positive arbitrage. Now think about this, life insurance companies don't break even on sales of policies until year 7, right? So that's why I always say to people, year 7, year 8 is kind of like the area where your policy starts to get supercharged, right? And so from that perspective, if we're looking at this, if we look at it from that lens, if we look at whole life insurance through the lens of the insurance company, we say, okay, they know they're not going to break even until year 7 and they're going to start to be profitable year 8. They're not going to allow you to be as efficient as possible until they're able to be break even. There'd just be too much risk to that. So I always tell people, common sense goes a long ways when you start thinking about this and you understand all the moving parts of how these things work. From that point on, I would say the other problem that we see with people who are interested in utilizing a whole life insurance policy as a foundational asset in their life is that they want to stop paying as soon as possible, right? They're like, how long do I have to pay on this? Well, I'm going to tell you, if you're thinking like that and you're thinking through the lens of like, how long do I have to pay? I'm going to tell you, you're thinking about it improperly, because once you get through year 7 or 8 in funding your policy, there's not going to be another asset on the face of the earth that dollar for dollar is going to be more efficient with all the benefits and attributes that dollar will give you. You just got to get through the capitalization phase through the first 7 to 8 years. Once you do that, and by the way, during that phase, it's still a great policy. You can still do some great things. We're going to talk about it, but the real benefit is after that point in time. And the whole idea of positive arbitrage is something that you need to get out of your mind when it comes to policy loans. And I think there's a lot of people online that are kind of misrepresenting how this works with whole life insurance and index universal life, but we're just going to talk about whole life insurance for now. So now let me go back to the board and I want to cover this a little bit here. So you can see here that if for instance we got it to year 5 and we want to take a $40,000 loan, this $40,000 loan, I'm going to go to the green marker here so I can stand out a little more here. So if we could pay 5% with the whole life insurance policy a year ago, and the banks are 1.9%, well, to me, this is 3.1% cheaper, right? The 1.9%, the cost of money is cheaper. Now, what's the benefit of this? Well, okay, so the 1.9% versus 5%, that's definitely obviously better, but what are the downsides of it? Well, it comes with structure, right? A lot of agents will tell you, well, you just go with a 5% loan no matter what, because you control it. You're never interrupting the growth of your money. Well, that only makes sense if it's you have this 5.5% number. Well, guess what? It doesn't work that way, because the net of this number isn't 5%. It's probably more like, honestly, at year 5, it's probably only more in the 3% range, right? So you're not really earning this 5.5%. You're only earning 3%. So you've got, if you're borrowing at 5%, you have negative arbitrage of 2%. Now, is that good? Yeah, I mean, for most people, even a year ago, most people don't have great credit, and if you're rebuilding and you want control, there's an unstructured component to this, meaning if you miss a payment, it's not going to hurt your credit, or you can manage it. If your income's a little more fluctuational, like seasonally based, you can manage it like that. But you're really not making positive arbitrage, and so that's first thing to understand. And at the same time, so is your policy earning uninterrupted compounding growth? Well, not really. Yes, the policy is going to grow. It's not going to interrupt. If you don't manage your loans, the answer is no. It's going to go backwards. But even if you manage your loan, the cost of the interest is going to be more than the cost that than the amount that the policy grows by. So a year ago, and remember, we're talking about a year ago because the interest rate environment has changed. Is changed in the last year, and I'm going to get to the current environment right now because I'm doing this from an educational perspective because I feel like there's a lot of videos that people watch, but they're all done with not all of them, but a lot of people are still thinking in terms of the benefits of how whole life insurance works in a low interest rate environment. Things are changing, right? And I'm going to talk about that more in a second. And so a year ago, we could get this 1.9. Now, if we use this bank to get the policy or to get the car loan, now, okay, there comes with structure. We have to make, let's just say we have to make a $700 payment per month, right? And that's structured. But if we could get it at 1.9 and we know we're earning 3% in the policy here, well, even though the policy was never used, we know that the policy is there to guarantee this $700 a month payment. So we can bake in that 1.9 or 1.1% positive arbitrage if that were the case. This was, once again, a year ago, okay? So that is what it is, right? We could have done that. And the reason we could is because the interest rate environment was low and it made sense to use banks. Now, this is, once again, using the policy loan, you can't do that. Now, why is this the case? I'm going to go over here. And I've done this a little bit recently, and I want to just kind of make sure that everybody understands this. If we go back 1980, right, and we go to 2008 here, and we look and we say, okay, 19% interest rates. Interest rates were up here, and so interest rates dove down, right? Interest rates were at 6% right here, right? In 1979, Paul Volcker jacked the rates up, right? And what happened was that this is interest rates. So white equals interest rates. Okay, now I'm going to go green, and green equals div rate. So what happened was the dividend rate in a low interest rate environment was, say, 4%, or let's just call it 5%, just for argument. The dividend rate came up. So you have to understand the dividend rate is always going to chase the fixed rate environment. And so let's just call it 1982 here, a couple year lag, that there was this crossover point because the fixed market, the insurance companies, as in increasing interest rate environments, dividend rate's going to be lower, it's going to chase it up. In a declining interest rate environment, the dividend rate is going to chase it down, right? And that is what it is. So this spread, you can see, the cost of money is the interest rate. It's the white. So this spread is where there was the potentiality or potential to gain positive arbitrage. And so this went down to like the dividends came all the way down to where we are at like 5 point whatever percent. And actually dividends kind of came over here and didn't hit like where we are now until like 2015. But like, once again, this is not to scale. But the bottom line is we're now going to this place where interest rates were low. Now they're coming up. And they're going back up again. Now, what's going to happen is we've been able to earn positive arbitrage, and the last decade has been the beautiful best place, right, for the ability to earn positive arbitrage. But moving forward here, we're going to have this crossover point here, very much like we had back in 1982, but it's the inverse, right, where now we're chasing the loans back up, and we actually have negative arbitrage. And the reason is, now we'll see what happens with the rates if they flatten out. And when they do, maybe as they come back down, we'll have another inflection point right here, right? And the rates will then chase back and we could potentially have some positive arbitrage again. But you need to understand this, that the idea of positive arbitrage in a policy is not an absolute principle. It's very much a circumstantial principle. And so therefore, we always have to be thinking about when we're utilizing policy loans, we have to be thinking about what is the cost of money? How can we create positive arbitrage and make it even greater? The answer is we utilize a bank, right? And by doing that, we're able to bake in this 3% positive arbitrage, or this 1.1% based on the cost of money and then the dividend, and we're able to bake that in, right? But if we utilize the policy in an immature policy, and if we use a policy loan, we're not gonna get positive arbitrage. That's important to understand. Once again, it doesn't mean it's a bad thing. It just means you're not going to be able to get it. Now let's go to right now, currently, because once again, I'm going to go over here. We have hit this inflection point right here where we're crossing over. A lot of companies have already hit this place where they've made this transition, this inflection point, this crossover point has happened, and there's not going to be positive arbitrage for the foreseeable future inside of whole life insurance policies. But I'm going to tell you that that's still not a problem. It's still totally fine, and it still makes a sense because we're making long-term decisions, and it's about saving capital, having uninterrupted compounding growth, and having flexibility. So now what do we have? We have interest rates have gone up. So policy loans are now, let's call it 5.2% all the way to 6.75% is what I've seen, okay, for different carriers. So that is the whole life insurance company. Now what are banks? Banks have actually gone up more. We're talking mortgage rates a lot of times are 7%, but for other types of loans, auto loans, personal loans, the rates have gone through the roof. And so now if we're looking to take a $40,000 loan, does it make sense to have that to utilize a policy loan? The answer is yes, right? And it's just because the cost of the cost of money is what it is. Now, going back, because I know I'm going to get some pushback on this, so I feel like I need to address it. Going back to the first thing where I had the 1.9% loan rate, bank loan rate, and 3% dividend. So for the 1.1% arbitrage, a lot of people are going to say, no, Chris, like you just want to control the banking function in your life. Why utilize a bank? Why do that when the whole purpose of getting a whole life insurance policy is so you can eliminate the bank and you could just utilize your policy as the bank? Well, it's because of the cost of money. We always want to be operating as financially efficient as possible. So from that perspective, the next conversation is going to say, well, now you have a $700 a month payment. You don't have that. That is a structured loan. That is a risk for you. Well, I'm going to tell you that if you take a policy loan, there's two components to this strategy that are better than utilizing your policy. A, when you take a policy loan, it doesn't impact your credit, which can be good and bad because obviously we live in a credit-based world. If you want to be able to leverage and kind of follow the rich dad principles and leverage credit to get more assets and create wealth, well, then you need credit. So thinking you're gonna it's a double-edged sword by eliminating credit. If you don't utilize credit, your credit goes down, right? And so you need to utilize that. So what you can do is if you took this $40K loan and you utilize the bank and you picked up a $700 a month payment and you're like, man, I don't want the structured payment. Well, from that point in time, you could guarantee, remember, you're never taking it out of the policy. If you use the bank, all this 49K is still growing and growing and growing. You have complete capacity to borrow against it. So I would say if you can't make your $700 a month payment out of cash flow 1 month, because remember, if you take the loan out of your policy, you're gonna have to pay that and service that loan. You should manage it, especially for a car. You should manage that on a monthly basis or whatever. Now, if you can't manage that out of cash flow because business is tough or you have a challenging time, then you utilize the bank, right? You're utilizing the bank in this situation at 1.9%. If you can't manage this loan, then go take a policy loan for $700 and make that payment. Minimize your risk and the expense of money and the cost of money by taking advantage of the cheap money with the bank. And then if you can keep it semi-unstructured, you just have to manage it by whenever you can't make a monthly payment, make the monthly payment with your policy loan. And then when you have the ability to make up for the policy loan, make up for the policy loan, right? That's how you can make this work. And that's why I say, yes, you want to take over the banking function in your life, but it doesn't mean get rid of the use of the banks. leverage the banks. It's all about control. If you can do this and you can control the relationship with the bank and leverage them to build your credit, leverage them to get access to cheaper money, and still have control because you have a policy capitalized, that puts you in the driver's seat all the way around. And this is one of the things that most people who are talking about this online are not talking about, and they don't really educate people about properly. And so I just want to make sure that is fully understood. Now we get to today's environment and we start talking, well, on an increasing rate environment, yeah, the whole life policy loans are going to be maybe not, your dividend is going to lag. So let's just say your dividend is still like, let's just call it 5.5%. And let's say the cost of money, let's just call it 6%, just for the sake of this argument in this situation. So you lose 50 basis points of arbitrage because you're not going to have positive arbitrage because of what I just talked about here. You got this inflection point, this crossover point. That is what it is. So you're going to have that problem. But the bottom line is it's still cheaper money now. So when you go and you compare it to what's out there in the market and what you can get, now all of a sudden borrowing against this 50 grand, this 49 grand seems a lot. It doesn't just seem, it's a lot more attractive. It's a lot more beneficial. You have all the things. The cost of money, comparatively speaking, is going to be cheaper. And so you just have to understand all the different moving parts. Now, the next question is, why does the whole life insurance company want to do this? Well, you need to understand how this works. First of all, if I have 40 grand, I'm taking $40,000 away from my 49 grand, and I have a $560,000 death benefit, why would a whole life insurance company like you to take a policy loan? A, it reduces their reserve requirements, because when you take this out, their reserve requirements are based on the life insurance. And so this loan is ultimately guaranteed by the death benefit. And so if they lend that out, well, that 560 gets reduced. And so that's a small component, but the bigger component on here is that life insurance companies right now, I'm going to just call it the general fund, right, is earning about 4.5%. So when you take a policy loan from a participating mutually held company, this is one of the things that people don't understand a lot of times, is that you're actually paying them 5.5%, but you're paying 5.5% into a fund. So that's actually an asset on the books. That's a better asset performance-wise for the life insurance company than they're earning on their general fund. So they like you having policy loans because it's basically the equivalent of a bond that's completely guaranteed for the company. And you know what? Like there's just a lot of moving parts to this that the life insurance company loves, from the perspective of, okay, they know that it's guaranteed, they know that it's secured, they know that you're good for it. From a cash flow perspective, it's an asset on the balance sheet. It beats the return of the general fund, so it bolsters the actual performance of the company when it's done properly. And so when you understand why life insurance companies like it, how the moving parts of loans work for you, when does it make sense to use the policy loan provision, when does it make sense to use a third-party bank, how does the market environment and positive and negative arbitrage, how does that work and impact your decisions? At the end of the day, you need to understand all this stuff. And here's the deal. We've been living, well, I'll say it, we've been living here, right? So remember, YouTube was created way back in this period of time. So the whole time YouTube and social media has been around, we've lived in this environment where there's been nothing but positive arbitrage. In fact, I mean, I would argue for the last 40 years that's been the case. And for the last 10 years, it's been magnified, right? So now we're going to this place where it's not. And a lot of people are going to have this come to Jesus moment where they're realizing, oh crap, it's not what I thought. The conversation around direct recognition and non-direct recognition companies are going to change. I still don't believe, I don't think one is necessarily way better than the other. It's just one of those things you just need to understand all the moving parts. We're thinking about it from a long-term perspective, right? You're buying this for 30 plus years, right? So if you're doing that, you've got to understand market cycles. They're going to go up and down, up and down, up and down, right? The wave is going to go down, and it is what it is, right? Like this is just, there's going to be these crossover points constantly, and this has happened for 180 years that the life insurance companies have been doing this. And so when you understand this, you understand how it impacts your decisions, and at the end of the day, the most important component to this has nothing to do with all the borrowing and all this stuff. The important component to this is that you're trying to build this capital reserve, and this capital reserve account and your death benefit is going to grow. So it's going to help protect your family. This is what I call self-completing plan, because as you're saving here, if anything tragic happens to you, this goes to your family, your business partners, whatever. But as this grows, you then become a more educated investor. You become a more an investor that has the ability to make better decisions based on your level of understanding, based on your access to capital, and based on your understanding of control and how you can have access to capital in different environments, whether it's in this environment today or whether it's like the environment was a year ago. You still have more control, and when you have control and you have access to capital, that's when opportunity tracks you down. And that is the principle that Nelson Nash always tried to talk about in his book, is that when you have access to this capital, opportunity has this way of tracking you down. And so that's really important. So if you have any questions about this, I encourage you, leave a comment in the comment section below. If you want to talk to somebody, I've got my team that can help you, that I've trained, that I've coached, that can talk to you about this, figure out what it would look like for you in your life. All you have to do is go down in the description, set up a free clarity call. It literally is not a sales call. It's designed to help you understand this more. Our mission at Life 180 is to educate people how this stuff can work in your life. And that's it. So if you haven't already, make sure you subscribe and hit the bell that we're notified every time I launch a new video. I've got videos coming out like this literally every single day. And hopefully you found value in this one. If you did, please give it a share, give it a thumbs up. Let me know that you found value in it. And that's it. Until next time, have a blessed, inspirational day. We'll talk soon. See ya.